Welcome to the latest edition of Fitch's Virtual Investor Series. I am Maria Paula Moreno, Head of North American Structured Finance. Today, as we look to discuss the 2023 mid-year outlook and rating performance for North American ABS, I am joined by my colleagues Bella and Ian Rasmussen, co-heads of our North American ABS sector. With 6 months into the year, we're seeing world economic activity holding up better than expected, helped by an easing of earlier adverse supply shocks. But with inflation proving stubborn and labor markets remaining tight, central banks continue to tighten monetary policy. The impact of this tightening on the consumer still lies ahead and could be amplified by more restrictive bank lending conditions as central banks withdraw liquidity. So to start, I'd like to ask you, John, what are the expectations on performance given and considering these macroeconomic headwinds?
Sure, yeah, I'll take a few of them because they sometimes give contradictory results or direction. On one side, we have the persistent inflation that you mentioned, higher rates, and I think that the fact that rates also accelerated at a relatively quick pace is certainly impacting the consumer. On the other alternative side, you have unemployment, which is at 3.7, incredibly strong. Even our latest geo forecast, end of 23, around 4% and only up to 5 in 2024. So the unemployment part of the equation looks pretty good. Inflation has moderated, or appears to be at least moderating now. So when we look at sectors, we think, okay, higher rates, inflationary conditions certainly lower impacting the household bottom line. And so impact on consumers is so far seems to be limited to the subprime part of the market or non-prime part of the market in auto transactions, certain parts of the card world, and unsecured consumer lending.
Ian, and on the credit card side, what are we seeing?
Yeah, so to John's point, there are a lot of contradictory signals that we're seeing. And in credit cards, we had very strong consumer spend at the beginning of the year, particularly in January. Some of that spend was credit creation, and so we saw credit card balances increasing. The sector's grown to about $1 trillion in outstanding balances. More recently, this year, we generally see a decline in balances after the start of the year as consumers reflect and start to pay down their holiday shopping. This year we didn't, and I think that starts to show us that consumers are a little bit more tapped than they were last year. And however, the performance in the credit card ABS programs is still very strong. We're kind of coming off of highs for the NPR rate and off of lows for charge-offs, but it still looks like there's strong performance still coming for credit card ABS.
Thank you, Ian. So this is on the consumer side, but what are we seeing on the originator side, John, maybe?
No, there's some interesting trends there. Clearly, the regional bank issues that have propped up in the last couple months have put pressure on certain aspects of the market. We see, like, for example, in subprime auto lending, certain credit terms and potential tenor of these warehouse facilities changing. There was an issuer that was unable to get to the ABS market because their warehouse facility was pulled in effect last minute. So some of those type disruption points we potentially expect to continue to see, particularly with the smaller finance companies, again, not necessarily limited to subprime auto, but across the consumer.
And are you seeing
universe.
an overall decrease in origination rate or not really?
Yeah, I mean, in certain sectors it's different. We've seen originations in the unsecured installment loan space start to decline with the tightening of the credit box, but I think that is also reflective of the reduced available liquidity. Regional banks, credit unions were big buyers of whole loan pools. And so that production, that origination wasn't all going to the ABS space. And so we're anticipating that there's going to be kind of a pullback in origination, both because of tightening of the credit box, but also available liquidity's declined.
And that tightening is a good thing, right? We want to see rational response to a challenging credit environment. And that's currently what we are seeing in most parts of the overall market.
And what should investors be looking out for the rest of the year? What trends?
Well, maybe to start off with, there's a couple of pandemic stimulus that's still embedded within the system. So we still have some excess savings. We believe that about 50% reduction in excess savings since August 2021, a burn rate of about $90 billion a month. We anticipate that that's going to be gone by the end of the year. So higher inflation will be more impactful when that excess savings is gone. But in addition, the student loan payment moratorium is ending and will be ending at the end of August. these borrowers haven't made a payment, a student loan, federal direct student loan payment in 3 years. The servicers don't know kind of where they are, the right contact or phone numbers, email addresses. So there's going to be a dislocation as servicers ramp up the, this servicing effort. 51 or 45 million borrowers. It's 1.8 trillion kind of in outstanding. So this is a big sector. And although the minimum payment's around $400, so not exorbitant, borrowers are going to be challenged to fit this into their payment priority, as John mentioned
And
earlier.
in the more traditional sectors, John, what performance trends should we
mean,
be looking at?
You mentioned it, payment prioritization. I think we're going to finally have a trigger event in, September, where this student loan moratorium, if it actually goes as planned, we might start to see some consumers make some different decisions. And that's something that we're watching. The good thing with most of the consumer asset classes is that the underlying tenor of these contracts are short. And delinquencies and defaults are still paramount, and they give you trends into underlying performance early on in the life of these deals. So we think we'll be fairly responsive to continuing to watch those trends, see what might continue to occur on the unemployment side of the equation, but we'll get meaningful feedback in subprime auto, in the broader auto markets, across the consumer universe.
Yeah, and I think an area of good information is the handset space, which wasn't around during the global financial crisis, but the carriers are underwriting the mobile handset loans to a big cross-section of the U.S. population, but they also have very strong servicing and collection efforts tied to the phone, to the the asset itself. And so we anticipate that if there is weakening performance there, that is really a show that the consumer is under considerable more pressure.
Thank you, Ian. I think that's a perfect segue. And maybe to wrap up, what do we expect for the performance for the rest of the year?
Our official outlooks almost across the underlying list of subprimes of consumer sectors is deteriorating. However, it's important, and a lot of what we're talking about is sort of what if and how does the response to these weakening trends. We don't expect rating impacts across most of these sectors, including subprime auto for the most part. So the consumer has been incredibly resilient. We expect what we're going to see is performance trends weaken, but we think the headlines, the broader financial headlines within these consumer sectors is going to sound worse than the underlying fundamentals in the ABS transactions.
Yeah, and I would just follow that up with just kind of reminding, with a reminder that we're expecting unemployment to go up by the end of the year to over 5%, kind of topping out in 2024 of just like 5 and a quarter. And so with that unemployment rate, we're not expecting considerable kind of default performance kind of across sectors. It'll be more localized to various borrower groups. And we've already started to see that in the unsecured consumer space, which I would say was the canary in the coal mine for the current inflationary environment that we're in, with delinquencies and defaults going up considerably last year, tightening of credit boxes in response to that. And so I think we'll see similar performance as we go forward, but it might not continue to increase like it has been given a change in borrower.
Well, thank you, John and Ian, for your insights today. And thank you for joining us today for this edition of Fitch's Virtual Investor Series. For more insights on North American ABS, please visit fitchratings.com. And if you have any questions on any of the topics discussed today, please feel free to send an email to the address on the screen. Thank you for watching.